Good morning or good afternoon, depending on which side of the country you're on. Welcome to McQueen Financial Advisors' last webinar of the 2021 year. Amazing year, different year, COVID year, non-COVID year, normal year. Things are definitely not normal. With that being said, welcome everyone. Really excited to have here. We're going to talk about bank and credit union transactions. We're going to give our annual update on the transactions in the industry. Next slide, please, Dan. I'm Charley McQueen, President of McQueen Financial. Thank you all for joining us. Really exciting. I get to work with this incredible group of people, and those of you who've been on the webinars throughout the year this year, you've met a bunch of them. We have our investment advisory division where we manage investment portfolios. We've had a number of conversations about standard investment portfolios and alternative investment portfolios throughout the year, a couple different investment 101 and 201 education seminars. I also have our great asset liability management or interest rate risk team, the second main component of our organization, and really exciting. We've had some ALM 101s and 201s, and also had CECL webinars that falls inside of our ALM team. So all sorts of different webinars there. And then our third group is our transaction advisory and valuations team. We've had a few presentations this year on different components. But this to me is really the pinnacle of the year for that team's presentations, and I'm really excited. And with the next slide, you'll see here that Dan Martin is joining me. Dan is our senior consultant. He's responsible for our valuation team and our transaction advisory activity. And Dan's doing a great job working with a number of our clients in all sorts of activities, from credit unions acquiring banks to clients acquiring mortgage companies, insurance companies, all sorts of different entities. And so it's been a great progress to see Dan get a lot of these things accomplished this year. It's been a big year for you. Yeah, it is. Thanks, Charlie. Appreciate the pleasure to be here today. It's great to have you and a great team with you. So it's a great group of people we have here at the organization, and glad the two of us are here to represent everyone else. Our next slide, give you a little admin stuff, all the important things here. If you do have a question, move your mouse around and bar will pop up, mostly on the bottom, sometimes on the top. And there's a Q&A button. Please click on that, enter a question. We'll answer the question along the way or at the end, depending on what is the better fit for the question. Today's webinar is being recorded, like all of our webinars. If you'd like to get a copy of it, please reach out to your McQueen Financial Advisor and they will send you a copy. You can also go to our YouTube channel and check out our videos that we have there also. So with that, we have an agenda. Yeah, so I think today what we want to start with is really kind of setting the picture of the market and the environment we're in today. So Charlie, I'm going to let you kind of kick us off with a little bit of an economic update. From there, we're going to talk about how that impacts, the M&A market as we see today. Talk about some of the different valuation metrics and drivers we're looking at in these transactions, and then get a little bit into the specifics of actual M&A activity taking place in the market, both on the bank side and credit union merger activity, and then inevitably getting to the phenomenon of credit union bank purchases. Finally, we'll talk about some additional growth opportunities that we see going into 2022, how to position yourself to take advantage of those, and then ultimately what it looks like moving into next year. So with that, Charlie, I'll let you kick off our economic update. Wonderful. All right, thank you. So we have our first question, which is always best before I talk about economics. And this webinar does not qualify for CPE credits. We will be doing CPE credits for all of our webinars this next year, so that's something that we'll be aware of. So thank you for the question. Just let everyone know that the CPE credits will actually be in all of next year's. All right. From there, let's get into the economic update. And this is what we call is a different yield curve, I think is the term. I look at this, and as we go through what's happening in this crazy world, interest rates have been all over the board. And for those of you that worked with us for a long time, you'll see the yield curve here. The black dotted line is the December 28th of 2012, and we've kept that as our comparison point for a number of years now. Why is that? Well, that was kind of the low point of interest rates before this cycle. And so giving it some good comparison, we then had a steep yield curve. Today, we've had a steep yield curve, but the last few weeks, we've had a lot of changes with long-term treasury yields, which have been going up, turning around, and coming back down. We're getting a bit more of a flat yield curve. We're looking at here, the 3-year treasury to the 10-year treasury is basically between 1 and 1.5%. Until you get down to the short end of the curve, it really drops down. So the yield curve here is telling a little bit of a different story than some of the inflation numbers we're going to see. The yield curve is still showing not as much concern about inflation as some of the pundits on TV today. So the next slide, this is one of my all-time favorite slides, those of you that know me. Why is this? Well, it gives us the yield curve over time and looking at just 3 data points. Excuse me, 3 data points in the yield curve. The first being the red line, which is the Fed funds rate. Second is the blue line, which is the 2-year treasury. And the third is the black dotted line, which is the 10-year treasury. This graph goes from 2002 effectively until today. And as we remember back in the financial crisis, the Fed raised rates, broke the housing market, rates came crashing down. We stayed in this low rate environment for 10 years, as we predicted correctly. The economy was recovering, rates were going up. A little bit of concern of some things in the economy that going a little too well, but slowly bringing rates up to normalize. We talked a lot about to normal rates. And then the coronavirus hits and COVID-19, and the Fed drops rates very, very, very quickly. And what we're in now is about 2.5 years into what we call a 5-year low rate environment. And we're definitely seeing some push in rates coming up a little higher. And so maybe we're somewhere around 2015, 2016. If we look back on the last cycle here, we're getting closer to rates coming up. But I remember a lot of people were calling for a 2% treasury just a few months ago, and we're back down to 145. So remembering to take back sometimes and look at it from just a more long-term focus. So next slide. This has been one of the amazing things. I've never seen the chart shoot up. It was terrifying how fast it shot up with unemployment, with businesses closing and the world changing quickly overnight. But we've now since recovered and we're back to effectively unemployment rates post or pre-pandemic. So our rates now are equaling pre-pandemic rates. We have seen some big changes though. We've seen a lot of people exit the workforce. A lot of baby boomers on the edge of retiring decided to retire. The stock market's done well. That's helped some people retire. The other side is there's a lot of working mothers and working fathers who decided that it's best not to have both work as kids have been home from school and continue to be stuck home from school with COVID quarantines. So it's making having kids and staying home very difficult. So a lot of women especially have left the workforce. And we are definitely seeing some older Americans exit the workforce too. So that unemployment number is good, but it's still tough. Auto sales, being here in Detroit, we always have to talk about auto sales. It is important though, it is a big loan driver for a lot of our clients. Unbelievable activities. You get into a pandemic, besides the government throwing money at everyone and deposit balances rising. What else happened is we had a disaster in transportation and logistics. The transportation and logistics market fell apart. We've had a couple storms and other problems, but there is not enough computer chips. And so here we're seeing automotive supply is terrible. Production they're seeing is coming back up. I don't know if I agree with that necessarily, but a friend of mine works at a car dealership and they said they were down to about a 3-day supply of cars. Car carrier would show up, they deliver all the cars on it. Within 3 days, they're back to no cars. So definitely an interesting environment today that's causing car prices to go up, used car prices to go up. That's going to take a while to fix this problem too. So the next slide. Home sales, it's been a great positive out there. It's been a great positive for the entire year. We expect it to continue to go well for the next few years. Now, what we saw here is for a long time, we weren't building enough new homes. We're slowly getting back to the pace of building enough new homes, but one of the problems is finding labor to build new homes. Not enough labor, not enough materials. Some of the lines I'm hearing of how long it takes to get a stove or to get an air conditioner or a generator is somewhere close to 10 months in a lot of instances. So building is definitely slow, and we're going to continue to see home values do well, especially with people wanting to have a little bit more of a different house with more of the working at home activities happening today. So next slide here, oil. One of the things that is an interesting thing, oil is a great indicator of economic activity. We continue to see the economic activity in the country improving. A lot of money out there, as I mentioned earlier, chasing dollars. But we've seen as oil continue to go up, and it's unfortunately getting to levels that are very detrimental to the economy. We start to get up to $90 a barrel, just like we were basically a few weeks ago. Some of this is self-inflicted. As a country, leadership decided to stop all pipelines and drilling. There is a ramification of that. Hopefully we get a little better energy policy. And I know we're all focused on solar and focused on electric vehicles. And while we all want electric vehicles and solar to survive, it's going to take a number of more years until we can get good mineral supply for batteries. And so as much as we want it sooner than later, it's going to take a while, and we're going to need oil to power things for quite some time. So I hope we continue to think more carefully about that to help propel our economy. The big slide, the one that everyone's talking about, is inflation. Inflation is definitely high. The consumer price index, ex food and energy, at 4.9. The PCE, personal consumption expenditure core index, the one the Fed really looks at, is at 4.12. And the overall consumer price index hit a record shattering 6.8% annualized rate this last month. And these numbers just came out the past day. So big numbers here. A lot of conversation happening. We actually have a Fed meeting tomorrow. Excuse me, I think about that for a second. Tomorrow at 2 o'clock. And the Fed meeting is going to talk quite a bit about tapering, how much they're going to taper or taper faster, and then the potential of raising interest rates. The inflation is here. Some of it's transitory. Some of it appears not to be. Wage-based inflation definitely is not transitory. And with that, with the Fed, we are definitely seeing the market predicting, the forward yield curve and the forward Fed funds market is predicting 3 rate increases between now and February of 2023. So overall of 2022 and into 2023. We don't think there's going to be quite as many. We're looking more like 2 starting somewhere mid 2022. But here we'll see in May of 2022, we have a 25 basis point increase projected. The market does. September of 2022, another 25, and then December of 2022. So the forward curve, and this is always incorrect, but the direction is a good indicator of where we're going. I think it's going to take a little bit longer to get there with that. So with that, next slide. I want to hand it off to you, Dan. And we do have this little bit of rising interest rate environments we need to be prepared for and work with. They're not the end of the world. They're not going to skyrocket overnight, but it is a trend that we're heading towards. And the yield curve is still moving slow as we predicted, but be prepared for it.
Thank you for that, Charlie. I think that that gives us a good background on kind of the environment we've been playing in the M&A space this year. I think 2020 was certainly a down year from a transaction perspective. A lot of pent-up demand that we saw materialize in 2021. That being said, with all that pent-up demand, with all that liquidity in the market, a lot of people sitting on cash, they want to put that to work. You look at some investment yields, kind of the decline in loan yield products, and we're looking for alternative places to put that money to work to achieve a improved yield. So a lot of that's been put into the M&A space. As of the end of the third quarter of this year, we have already surpassed all of 2020 in total transaction volume on a global scale. So that alone is a pretty impressive number. From a pricing standpoint, we've seen an increase in multiples a little bit due to increased demand. Announced deals have gone up due to that pent-up demand. And so we've really seen a lot of momentum in the M&A space gain traction, and something we really expect to continue forward into 2022. So with that, just looking at some overall trends for our industry. This is something we come back to in this presentation on an annual basis. Is from a branching perspective, you really got to reconsider what we're looking at from a branching strategy standpoint. We're continuing to see a decline in branch locations. You tend to see a news article almost weekly of some bank getting rid of 10, 15 locations. So, thinking about smaller branch footprint, where you really need to be best to serve your member or customer base. Just some thoughtful consideration going forward. With that, I really like this graph because it shows kind of both our branching footprint, but then also that, as a whole, institution-wise, we are in a consolidating industry. It's been consolidating for a number of years, and we expect it to continue to do so. So, Charlie, I think your favorite saying is, not only do we want to survive, but we want to thrive. And I think that's really applicable here, is making sure we're doing the right things to continue to thrive not only in this environment, but in a changing interest rate environment as well.
Yeah, it's a big decline from 16,000 institutions basically down to 10. I mean, it's a big decline in 10 years.
Let me ask you this: when was the last time you saw a new bank chartered? In addition to this,
We were in the death of no bank charters for a number of years. After the financial crisis, the political landscape really went against forming banks and made it extremely difficult, if not, some would tell me absolutely impossible. But we look at these numbers. I mean, I understand why things went down quickly in 2009 and 10, but 11, 12, 13, 14, 15, 16, effectively 2 banks were chartered. And as we see what happened, we're beginning to see a bit more here in 17, 18, 19, and 20. It still is a tough way. The regulators are requiring a lot of cash. We've been hearing $30-35 million type raises to start a new bank today, which is it's a difficult number to hit, especially when you used to raise 10, 12, 15 million to start a bank. And so we are definitely seeing a lack of new starts, which it's hard to believe. Back in previous decade before this, we were talking about 150 to 180 new banks a year. It was just really pretty incredible, and it just went to nothing.
Yeah, I think that's a perfect segue into why people are looking at a purchase as opposed to any other outlet, right? So you start to think about some of the reasons as to why an acquisition may make sense to you. If you're looking for geographic diversity, maybe you're looking to acquire some new talent. But really, I think at the end of the day, it all comes down to growth. It just depends on what area you want to focus on. So whether that's loans, whether that's protecting your existing market from a competitor, all sorts of different reasons as to why to buy. And then you start to look at the flip side of the coin, and you think about, well, what are the reasons I don't want to engage in this? And for me, it ultimately comes down to, A, do I have enough capital to do the transaction? Does the price or price expectation make sense? And then ultimately, does my team internally with the advisor team I work with have the capacity to do this transaction? Typically, with the help of McQueen, we can certainly get you there. I think this just illustrates a really good point for institutions considering a transaction. This is just showing the distribution of loans between credit unions and banks. Banks having a much larger commercial focus than a typical credit union institution. And so this is a great reason as to why you may want to look at an acquisition. You may be able to tack on a commercial line of business or a consumer focused institution and really diversify not only for your members and customers, but your own loan risk.
It really is interesting to me, Dan, that if you think about it, 2 and 2 can equal 3. And the way you do that is by using the commercial loan of this example of one institution and the consumer loan of the other institution, the divisions, to come together and cross-pollinate, cross-sell each group. So it's really interesting data when you look at it this way.
Right. So then, if we look at kind of what do we look for as far as value, what do you typically find value when looking at these types of transactions? And so I think the big one for me is going to be earnings potential. What can we do by acquiring an institution? So if we acquire somebody that's making $1 million a year under our umbrella, can we make $1.5 million? Can we make $2 million a year? What's that growth we're able to achieve through an acquisition? And then, you also look at geographic locations. Is there, access to a new metropolitan area? Is there providing more access to our existing customer base? Are we getting, some superstar loan officers? Those are all things that you really look for to drive value in a acquisition. Things that may take away from value or provide less value. A lot of it's going to have to do with kind of balance sheet structure, how their income and expenses are structured, how much capital do they have. If they have a bunch of excess capital, I don't want to pay any premiums for that. And then ultimately it comes down to the transaction itself. All of these are very unique, so you have to look at all the attributes that are in play here to determine, at what price does it make sense? Am I getting good value? Is it gonna, catapult my institution forward? From there, just a couple things we like to look at on these transactions. Typically if we're looking at a purchase, I really want to make all my money back in 5 years or less. Certainly we can look and come up with reasons as to why you may go beyond that. If we're trying to block a competitor from entering onto our turf, that can certainly lead to higher payback. If it's going to achieve substantial growth, you can make an argument there. But really we want to focus on that 60-month or less payback premium. From there, understanding cost savings and potential revenue enhancements, as Charlie mentioned, kind of on the loan crossover there, what can we really do with this thing post acquisition? How is it going to help us moving forward, achieve more growth, become more profitable? Where can it take us? And then finally, when it comes to actual, offering of price, cash is always king. It's known and certain. Stock offers often can result in higher headline numbers, but we've seen a number of deals fall apart because the stock ends up tanking, and then the deal is no longer viable. So a little more risk there, but cash is always king. So with that, Charlie, I'll kind of turn it over to you on kind of what we see, as another incentive as far as efficiency gains with our clients.
Yeah, Dan, it's a great comment you had there, and the efficiency ratio is one way of looking at things, and it is amazing. 90% efficiency ratio with asset groups under 50 million, and then a 55% efficiency ratio at 10 billion. You do get lots of economies of scale, a lot of regulation, a lot of activities you don't need to do. As two institutions, you have to only do half of it, or one version of it when two people come together. The size does really help. For years, I remember the stories about people giving advice to clients that, look, you've got to be at least 50 million to survive. And now we hear more people saying you've got to be 100 or 200 or 300 million to survive as it grows up. I think you can be successful at any size. You just have to be prepared to work through the uniquenesses of that situation. But size does really scale well in our industry, as you don't need 2 CFOs, 2 CEOs, for example, to run an organization that's 500 million or 250 million. And so scale is very important. And with regulation, scale is very important. And, I think here the side too is, remember, if you're doing a lot of small, $2,000 holiday loans versus a $10 million commercial loan, there's a lot of the same time frame, obviously a little bit more in this theory, but there's the time frames can be relatively similar in different types of loans. And so it is scalable, easier when you get bigger. Bigger isn't always better. I'm not wanting to walk away with this thing. We're saying that everyone has to be bigger, but it does help the situation being a little bit bigger, especially in a tight margin environment.
Appreciate those comments. And if we look at kind of just some of the larger transactions that have happened this year, we had 2 deals in the deal value column here, hit almost $1 billion. So, typically we see a fair amount of large transactions. We had this SVB Financial Group deal for about 10 billion in total assets. It's the largest this year. Last year we had a significantly larger one with some large player industry consolidation, but definitely still some large deals taking place in the market. If we kind of look at, where the market has gone this year, as I mentioned at the beginning, you can see this huge jump from 2020 to 2021 as far as volume. This is only through the end of Q3, so I expect, we'll finish out the year pretty strong here and see much closer to 2019 level numbers. From there, just looking at some of the most recent deals, kind of where they're pricing. This is kind of a trend that we've seen probably through the 3rd and 4th quarter of this year. Many more smaller institutions that are trading for, less than that 1.5 to 2 times book have been trading hands. A lot of people are looking to take part in the market we're at. where you might be able to get some premium pricing due to the amount of demand for institutions in the space right now.
It's pretty interesting, Dan, your pricing there. It's all over the board. And one of the things when people ask for that cocktail party number, where would banks trade? You know, we always look at the earnings, focus on the earnings and the quality of the institution, and kind of the price to book's that backward side of it. But look at that price to book. So here you go.
Yeah. No, I think that's great. Is, you know, this is typically the headline number everyone likes to talk about is what did you get for price to book? But when it comes down to it, price to earnings is really the most important part there, because that's what you're getting on the go forward basis is that earnings stream. So as we can see here, we've had some pretty big fluctuations. You know, early 2000s, we had our average price to book above 2 times. I don't think we're going to see that anytime soon. I do expect probably 2022 to pick up a little bit over 2020, but you know, again, we're pretty close to in line with that 2019 number as a market. Although what's interesting is, you know, given this as a whole, there are some key differences. Charlie, I don't know what you've seen, but geography can certainly play a pretty big role as well.
Yeah, geography really can make a big difference. You look at some of the population trends. I read an article this morning about the decline of young people in Illinois and how the state's struggling. And so it's interesting. When you look at the age of Florida, and how the age of Florida, the average age of Florida is 42 now, which no one would probably believe that. So we are seeing people move to different areas, warmer climates, and changes. So that's a fair point, Dan. All right. So with that, you know, here, and look at this here, this page 27. It's interesting. The average deal tangible book value is up to 190. As Dan did point out, though, there's a lot of lower numbers involved in there too. But we're seeing some pretty good pricing numbers. It is a good time to sell, one would take, just like housing market. It's a good time to be a seller instead of a buyer. If we look, though, the last couple of years in these divisions and areas, and I think going back to my having fun with Florida, having a 42-year-old average age when all of us probably think that it should be 70, it's not. It's become very young, and the Southeast, the Southwest, and the West are really where people are looking to move, and we're seeing the value of banks go up, where we actually have a lot of institutions saying, hey, my customers or members are moving to this area. I need to open a branch there. Why don't I buy something there? And so we're seeing that take place. The Northeast and Mid-Atlantic is definitely struggling a bit lower. It's not that no one likes the Northeast. I think there's a lot of those areas, there's not that many banks left, and but there's not as many people wanting to be there. But overall, some good numbers, but some pretty big disparity going on around the country right now, Dan.
Yeah, I think if we look at this set of tables here, this kind of further illustrates that point. Just looking at transaction volume, you can see the Midwest, we have 75 deals year to date, whereas, you know, in New England, as you mentioned, there's just not a ton for sale. We only had 4 deals come to completion there. So really pretty big disparity. That's why you kind of get the huge swings in pricing too. You know, 4 deals, is that really representative of a comparable to 75? Probably not, but it's interesting nonetheless.
Yeah, and you can see the number of institutions, 535, and then, you know, the one that's getting interesting to me is the Southeast. There were 44 deals, but it's down now to 1,700 total institutions. So we're definitely seeing these numbers come down, and then those that are good with math, we'll see Midwest is at 3,700 institutions remaining. So there'll probably be a lot of deals happening in the Midwest. I just look at this from a comparable basis.
All right. From there, looking at kind of the credit union industry as a whole, and how this has played a part in the transaction world. You know, we've had membership growth of, you know, single digits the last decade or two. And then here we can see we had that big jump up in asset growth due to all that free money from our government. So 13% asset growth in 2021. You know, something we actually don't expect to run off a ton of, but obviously provides an opportunity to put a lot of that excess cash to work.
It's going to be hard to keep those asset growth numbers up that high after the spigot gets turned off a little bit here.
Yep. All right, so this is I think this is a pretty telling graphic here of, the consolidation taking place in credit unions. As we talked about, efficiency and scale, less than 10 million asset sizing for credit unions. I mean, that's a straight line down. Even 50 to 100 million consolidating at a faster pace, greater than a billion. We have growing 500 to a billion. We have growing 100 to 500. We have growing a little bit, but really those smaller institutions, as they face more pressure to kind of keep up from a technology standpoint and really just a service standpoint overall, are going to struggle when you start to compete with the larger players. Another interesting trend, obviously with all that liquidity in the market, our loan to share ratio has dropped throughout this year. Third quarter of 20, we're at 75%. Now we're closer to 70. We've seen some good loan demand in some specific products. Home equities come to mind with the increase in housing prices. But definitely there's a fair amount of money to put to work compared to historical standards.
Yeah, we're seeing that, and then I bet we're going to see, besides home equities, maybe a little bit of credit card debt as people start to spend a little more. But it's been tough.
From there, we can take a look at kind of delinquency, and I think this applies to both bank and credit unions, although it says credit unions. But looking at the losses we've had over the last 5 years, we are at very low historical losses. A lot of people had fears that COVID we were gonna lose a lot, and frankly, we did not. And so I think that's one thing to think about going forward is, if our losses are to, revert back to the mean, what does that look like to our institution?
Yeah, it's definitely could be some difficulty, but I'll tell you, I don't see losses coming back in the industry for any time soon, given the performance of the stock market and the performance of housing values. It's tough to default when your house, oh, by the way, your car is worth 30%, 40% more than you thought too, but tough time to do that.
All right, from there, so we're actually seeing a slight increase in earnings despite some margin compression here. Our ROA has picked up. A lot of that's going to be due to those losses being at small levels. Charlie, what have you seen with some of our clients been doing to improve earnings?
There's all a little bit of bifurcation. Some with really good earnings, some with struggling earnings, and historically, though, we've seen people with good earnings have been having lots of non-interest income. Looking at some sort of mortgage group or division or some sort of activity, you're going to gain on sale of mortgages or things from investment activities or revenue from insurance products. And so those are some of the things that we've seen. Now that is changing here now as mortgage volumes have really come down substantially. And I think what we end up happening with this margin, and you can go to the next page and talk to us a little bit, but I think with the margin going here down, which this page really shows how far we are getting down here, that non-interest income is still really important. It's hard to get with mortgages gone. And so what else can we do? Well, now there's a couple things. Interest rate risk management, asset liability management. I'll talk about ALCO and how ALCO is something that people get bored at going to at times. We like to joke about that, but really ALCO is the cornerstone of managing the balance sheet. And today, the successful institutions are really going to thrive over the next 2 or 3 years for excellent balance sheet management. We have the beginning of a potential rising rates. We're looking at maybe the Fed raising rates. We're looking at still lackluster loan demand. And so along with making very good ALM decisions, and really what that is structuring your balance sheet correctly, and that involves getting into the investment arena, making sure all these additional deposits you have are fully invested. They're not just sitting in cash. Make sure you have a good laddered portfolio that fits your interest rate risk and ensures that if rates rise, it doesn't hurt you and actually helps you now and it helps you then. And in the credit union space, alternative portfolios, another area to really drive value, to get some additional revenue in to help out. So to me, this environment now with where the margins are headed and nothing is going to beat just outstanding interest rate risk management, balance sheet management activities to ensure profitability as we move forward.
So taking kind of those income strategies, some of the ways we look for to kind of fuel growth to also help with our income here, kind of on the credit union side, we talk about the cheapest and down to the most expensive ways to grow. And so I think the first thing you look at is a merger of equals or merging in another credit union. That is the preference, as there's no purchase price technically paid there. And so combining the institutions really just benefits both membership bases there. The second one and third one, if the credit union buys or merges in a credit union branch, that would be second most preferable. And then going and acquiring some existing bank branches or purchasing branches is also another viable option there. And then you really get into kind of two of the more expensive activities, purchasing of a bank, which, typically we'll look for that 5-year payback period. And then when we start to think about kind of the most expensive growth strategies from an inorganic standpoint, we look at what it costs to go and start a new branch from scratch. And typically we might be looking for anywhere from a 5 to 8 year break-even point before we're profitable. So much more expensive than any of these other paths to go down. So just something to consider if we're looking at this type of activity. So from there, looking at kind of, approved credit union mergers, reasoning why people are merging into other institutions or merging together. Really the number one is going to be expanded services. As we talk with size and scale, you're able to offer your membership or your customer base more loan products, more deposit products, better rates at a larger size. It's easier to be more profitable when you're larger. The other two reasons, poor financial condition or loss or decline of membership field. Those are kind of one-off special situations, if you will. I think most credit unions that are merging together today are doing it for the benefit of expanded services. Now, if we take a look on the bank side and look at kind of bank deals that have been announced this year in the M&A space, we can see a pretty good spread kind of in the Midwest, as you alluded to, a lot of activity there, Charlie. Good amount in California, Texas, and Florida as well as the Northeast. So really all over the board. But a lot of these tend to be on the smaller side when we look in the Midwest. And, kind of the coasts or those premium markets with the largest populations tend to be where the larger institutions tend to trade hands. If we look at year-over-year comparisons, total deal values, 2019 we had that one large deal, created the 6th largest bank in the country there, so we're a little bit skewed results. But overall, a pretty good trend as far as increasing bank deals, and something we expect to continue to see on a go forward. Looking at credit unions buying banks, this is a trend that really kind of took off in 2015, and something we expect to continue going forward despite some legislative battles going on in states throughout the country. But as you can see here, I mean, the average size of the deal has significantly increased. Some of that's due to our asset size being inflated, but I think a lot of it has to do with larger players getting more comfortable with the activity and continuing down the path of inorganic growth. A lot of these tend to be repeat buyers who have done one transaction, get that under their belt, get comfortable with the process, and realize it's really a great avenue for future growth.
I'll tell you, it's tough, especially in a pandemic, to go out and get people to come into your branch or meet with you and sign up. It's an interesting growth strategy versus organic.
Yeah, and I think you can see that here if you look at just total volume trend. You know, we've had a significant increase in recent years as more people look for growth in other areas.
Yeah, absolutely. Lots of growth and trends really quite amazing.
If we look at kind of where this has taken place, largely Florida, a lot of larger institutions down there looking to pick up, you know, those $100 to $500 million institutions. Midwest all has a decent number. Surprisingly, none in California yet, but you know, mostly Midwest and Southeast. Year to date, there's been a decent amount of activity. We look at some of these deals. We see ViStar had the largest of the year at $1.5 billion. And then you look at Green State, who did 3 bank deals or announced 3 bank deals this year. Has been a pretty big player in this arena.
Yeah, a lot of repeat stuff, a lot of interesting transactions here, and some Florida, Illinois, all over. Interesting.
Yeah, a lot of concern when looking at these deals, when talking with clients, is deposit runoff. You know, going from a bank to a credit union, what that's going to do to your membership base, your deposit base, and frankly, as we can see here, on average, you know, we've actually seen increases in both membership and deposits. So a little bit of a contrary thought, but something to point out that a lot of people don't consider.
Yeah, it's good data. Thank you.
So from there, when you're thinking about, you know, does this strategic path make sense to me or my institution? You really gotta start with, are you in a position to acquire? And so what does that mean? I think the first thing we want to focus on, as Charlie alluded to in his comments on income, is really we need to build up as much income and capital as we can to go forward. You know, I think my favorite method of doing this is setting up an employment benefit account or a charitable donation account, as those are easy ways to add additional dollars to your bottom line effectively at no cost to your institution. Something our investment team here at McQueen can certainly help you with. I think it's a great starter to go down this path. You know, and then once we've kind of developed and assessed that financially we're capable of going down the path of an acquisition, you know, we really need to determine what that appropriate strategy is, what that looks like. Once that's formed with your team, board of directors, whoever may be involved there, the final step is really to start searching for the correct candidates that are going to help us achieve what we want to achieve.
You know, one thing, Dan, before you leave the slide, I think position yourself to acquire is probably one of the most difficult things, but easiest things to read, hardest to implement. Making sure that you're making good money. You've got the different ways to make money. You have non-interest income solutions. You have interest earning solutions. You have loan growth solutions. Really making sure you're putting yourself in the best position forward to go forward and to grow from there. So easy to say, quick bullet point here, but man, that's a lot of work under that one right there.
Yeah, I would completely agree with that. A lot to unpack. Yeah. So I think the biggest things when determining, you know, success in looking at these types of opportunities, first, does it fit with your overall strategy? Do they have lending that coincides with yours? Is there crossover lending that you can do there? Do you have the adequate capital to do this? If not, you know, we can raise sub debt for you to make sure you do have the adequate capital for it. You know, what strengths are really going to transition to your institution? You know, what can be taken from under your umbrella, implemented into theirs to improve profitability? The next piece is really, if you've never done this before, there's a lot of nuances, title change, product pricing, deposit pricing to be aware of as you go through that process, something that we can help you with 100% along the way. And then really the last piece focuses really on integration and making sure you have an adequate integration plan with all the members, with the community, and making sure everything's communicated well and efficiently. From there, looking at other ways as opposed to purchasing an institution. Some of the things we've done recently, mortgage companies roll up, standalone, bring in a high volume producer, looking at purchasing stakes in a QSO or an alternative investment company. You can buy a piece of it, you can buy the whole thing, you can start one. Buying an insurance company, rolling that up under your umbrella, offering that to your customer membership base. Wealth management, same type of thing. These are really nice ways to add some non-interest income and also really some other services to your existing customer base.
Dan, I like this because one of the things we always want to make sure we're giving all of our audience here some good actionable ideas when we give presentations and to think about. And we've given some good pricing indications, and we think pricing is going to continue to be strong here. We got a couple questions coming in, so please add more. One of them is about taxation and the Biden tax policy, and so we'll have fun with that. But some of the other advice things here, besides we think that values are probably going to stay fairly high. What else can you do to make more money? And that's really important thinking about this. And every institution is different. And everyone's market is different. Figuring out which fits in your market and making the work to get it in place. So really great information about your Dan. Thank you.
Absolutely. I guess with that, before we get into the questions, Charlie, you want to give everyone your expectations going into 2022?
Yep. Thank you, Dan. So I do think 2022 is going to be an interesting year. Obviously, we hope that COVID becomes less of an issue and the Omicron variant isn't as bad as some say. And we get down to a normal, dealing with a disease that's around and we're okay with and we live with. We'll see. 2022 may not be the year. Maybe it's 2023. But with all that, I do think we're going to see a lot of subordinated debt offerings going on. We've seen it in the banking space. We've seen a ton of debt issued for capital. The credit space, we're really seeing it take off with subordinated debt. I know our team here, Dan, with you and Zach Farr and the rest of the group are really working hard on these. Pretty exciting stuff. But I also think loan growth is going to have to be the key. We've had 6 years worth of deposit growth in the past 5 quarters. And now we need to do is get loan growth for the next couple of years to catch up with it. So it's going to take a while. And that's really that whole getting into the asset liability management or ALCO activity, making sure you're really working hard to get the loan focus and manage the balance sheet correctly. Because with that, interest rates and inflation, interest rates are going to be low. Is there inflation? Yes. But I do think we're still talking maybe about a little stagflation coming in here. And so we have to be careful. It appears that interest rates are going to stay relatively low for quite some time. That doesn't mean they can't go up a little bit. And I do think they're going to come up a little bit, but we're not talking 4s and 5s by any stretch. And so that's going to make things a little bit interesting here. And so we're going to have a lot of conversations about inflation. And tomorrow, the Fed meeting at 2:00, we're going to learn a lot more. But definitely we're going to have to be prepared for this. And then the last point you have here, Dan, is really interesting, is the fintech and digital institutions. There continues to be a lot of activity happening in that space, and it's going to continue to grow. Lots of threats from Walmart getting into things to other entities. We're going to continue to see that happen, and that's something that's just going to make us have to be better at our game, better at our technology, and continue to be the great, awesome institutions that all of us are. So with that, flip to the next slide, unless you have anything to add here, Dan.
No,
all right, well, we're going to leave this screen up. We're going to go to some Q&A now. And we'll talk about this next webinar in a little bit. But so a bunch of questions have come in. And Dan, one of the things that people have said that they expected that 2021 was a larger than normal year for transactions due to the threat of the extremely high tax rates on capital gains that President Biden has put out there. Do you agree with this? And what is your projection for federal government actually making tax changes in 2022? What a loaded question.
Yeah, a lot to unpack there. I think in the first half of 2021, we certainly saw a sense of urgency from a lot of sellers that were looking to get a transaction completed in 2021 to avoid that. I think in the second half of this year, a lot that's been less of a talked about point as to why people are are going to sell, largely because you're probably not going to complete a transaction in the second half of 1 year. So I think it was definitely considered, and in the first quarter we saw a lot of activity from that. So partial effect there. And then taxes. I can never speculate on what's going to happen. I'd love to say I have a crystal ball that's going to tell you exactly where it's going to go, but shot in the dark.
Yeah, I think it's going to be interesting here, and I think it's going to be tough to get that passed. I know they're struggling to get a lot of bills passed, but it's one that it's made a lot of panic selling. If it does happen, it might slow things down a little bit here. So I think likely that it won't happen. All right, next question from you, or for you, Dan, excuse me, is have you seen an appetite of big banks selling off branches, and this trend that's taking place, or they just opt to closing branches now? Again, the question, kind of two parts as I read it here, is do you see big banks just closing branches, or do you see them selling here and going forward where they could retain their customers through the digital avenue only and not have the physical presence?
So we've seen a little bit of both. Oftentimes when we see a bank is going to close branches, we've reached out on behalf of many clients to inquire if we can acquire those, because that's a great opportunity to get into a market that your largest competition is probably leaving. So from that standpoint, it's a little bit of an opportunity. Also, on the flip side, we certainly have seen larger institutions peel off and sell off branches, but a lot of those, they tend to not be the best of branches that are getting sold off. And so you might not get exactly what you're looking for in those types of transactions.
Yeah, I think it's a fair answer there. I do think you probably see both continuing, and sometimes people are just going to want the biggest amount of money they can, and it's not an area of focus or geographic region they want to be in. And then the other one is if I can retain all of them, why would I retain all my customers? Why would I sell them? And so it's a really great point. I think we're going to see a little bit of both. Another question that came in, Dan, when you talked about a 5 to 8 year break-even point for a branch, do you have an average deposit size in mind as well for breaking even? And I'll give a little fun. We do have the Charley branch math, which means every branch has to be $50 million, which we break that rule all the time, but it's always a fun number to throw out there.
Yeah, I think it's going to depend a little bit on your operating structure. For example, somebody that's in in a large city location is going to have to pay significantly more for that real estate. And so you're going to have more deposits there in order to make that a profitable institution, probably closer to Charlie's $50 million number. In some suburban markets, you might see $30 million be a more realistic number, 25 million, maybe in some rural markets, but it's going to kind of depend on the specific situation.
Yeah, it's interesting. We have a client who's very successful at opening branches in rural locations, and the branches get to 15, 20 million in assets, and they're open sometimes 3 days a week. And so they can make them very profitable. And so it is a tough one. It's a bit across the board, but it's your business model that has to meet the needs or the structure with the branch size. So one other question that came in, any idea on how much recoveries from the corporate failures have added to the non-interest income growth in credit unions this year? I'm trying to remember the basis points. I know the number, but I can't remember it right now.
I don't have it either. I know it was pretty significant, though.
It was a 10 or 15 basis point hit the improvement to ROA, I believe. We'll get the answer to that, and we'll send it out to the person that requested. Make sure all the advisors here know, so anyone else that's interested in that answer will be able to get it. All right, that is it for the questions that have come in. And I'd like to really start by thanking Dan for putting together this webinar and sharing his expertise with everyone and spending some time here. So thank you very much, Dan. I'd like to thank the entire evaluation team. And we do have our next webinar coming up here. And if you go back one slide, Dan, as I forgot the date, but our next webinar is actually going to be exciting. It's our MFA Economic Update, Where to Grow in 2022 on January 19th from 2 to 3 p.m. Every year we do a big kickoff, economic kickoff, where we talk about products and services and different things to do where we think that you'll be able to get growth successfully in 2022. So we're really excited to see that. So with that, thank you, Dan, again, appreciate it.
Yep. Thank you for having me and allowing me to present today.
I appreciate it. Hope everyone has a wonderful rest of their morning or afternoon. Again, thank you all for the continued relationship with everyone here at McQueen Financial Advisors. Have a wonderful day.